Hello, good afternoon. Welcome to MK Convenience Brokerage. My name is Mohammed. In this short and ripped video, should I say, I'm going to explain to you some of the terms. I have other terms as well for insurance terms, but this one I found as for now, and I'll be uploading other ones as well. But let's get started. The ones that I have at this moment, it's only 2 pages, so I won't take time, and it's half of ripped, so it's not even going to take a lot of time. So let's get started with twisting. The practice of reducing a policyholder to lapse or cancel one policy in order to replace it with another to do the determinant of the insured. Now, twisting is common. It's not common practice, but some people do practice it. What they do, they make a policyholder's lapse, which means they make it close to canceling it or cancel a policy, and you replace it with something else but cheaper. And you're charging more money to the insured what a year than you gave them a cheaper price, and the insured doesn't know about it. Basically, you can think of that as twisting. Umbrella liability coverage, designed to provide coverage for higher limits, access coverage that are generally available under basic liability policy. So basically, what umbrella liability coverage is let's say if your homeowner has coverage, they don't give you $1 million coverage, you'll get a basic coverage for, let's say, $500,000. If a house burns down, for liability coverage, or for, should I say, dwelling coverage, they'll give you $300,000 in liability, but that's a regular coverage. Umbrella coverage is an extra coverage. Basically, they give you something extra to protect yourself and your home. So that's what umbrella coverage is. They give you liability exposures, higher limit of whatever basic liability is, in order for you to protect yourself. You could say also as an extended liability coverage as well. Underinsured motorist coverage basically covers an insured when involved in an accident with a driver who has auto liability insurance, but the limits of the insurance are insufficient to pay for the insurance damages. Underinsured motorist coverage basically, let's say if you have it on your policy. If you don't, then you're not going to get covered. Underinsured motorist policy is usually covered in high coverage, full coverage, should I say, but you gotta check with your agent or broker depending if they gave it to you or not. So let's say if you hit somebody's car and they don't even have liability coverage, or they have minimum liability coverage but your damages are more, that's where underinsured motorist coverage will come in to cover the rest of the insufficient pay. Underwriting, the process of which prospective insurers are reviewed or examined for the capability are as insured. Underwriting or underwriters are the people that check for basically to see if everything's correct, everything's up to date. They're also called the masters of insurance because they read everything in detail. So let's say, for example, if you're covering a home for a person and the underwriter checks everything out, make sure everything's good, but they find something was wrong. Maybe the house was 3-family home and you're covering for 2-family home. They're the one that look into smaller details in depth. Maybe the square footage wasn't right. They look online, they find more information, they see that, oh, this wasn't a home, this is the building apartment. That's what underwriters do. They're the people that they usually make sure everything's clear and they help you bind the policy. Unearned premium is basically premium that has been paid to an insurance company but which has not been earned from the insurer's standpoint. Basically, let's say you pay for 1 year premium. That's what the premium is. Unearned premium is basically, let's say if you have certain months that you didn't get paid or they're giving back to you, that's called the unearned premium. They didn't make money out of it. Unilateral contract is one in which only one party, example the insurance company, makes legally enforceable promises, in contrast in a bilateral contract. So the unilateral contract, only the one company, which is the insurance company, they're the only one that make the promises. Like, we promise you will give you this, we promise you give you that. That's what the unilateral contract is. Bilateral contract is basically both parties agreeing to do something in the future. So let's say, for example, the insurance company and the insured, they agree upon something, like say, okay, if something does happen, we will work together about this. That's what the bilateral contract is. Unilateral is only one person making the promises. Surety bond, a guarantee of an obligation subject of such bonds. Basically, something with the bonds, if people do get bonds. Surplus line broker, the individual partnership of corporation licensed in a given state to place insurance coverage with non-admitted insurance companies. Well, what is a surplus line broker? So I'll give you an easier example probably than this. Let's say, for example, I work in New York State. I have a license in New York State, and I want to write insurance, a home insurance in New Jersey. What do you think, if I'm able to write it? No. Why? Because I don't have a license. That's where surplus line brokers kicked in. These people have license of other states. And so if I can get that license, if I apply for it, then I become a surplus line broker. But I don't have it since I'm just a broker in New York State. Surplus line brokers are able to write insurance companies with unlicensed insurers. They do full amount of insurance. Basically, their purpose of obtaining a lower premium rate. They give you a lower premium. They're good at it. They usually help you out with a non-admitted insurance carrier. Non-admitted meaning that the insurance company are not located. Let's say if I again using an example, if I'm in New York State and I'm supposed to use insurance companies within New York State. If I'm use New Jersey's insurance company, that's a non-admitted carrier because it's another insurance company in another state. That's how it works. Tail coverage under the commercial general liability coverage, one or more extended reporting period, also known as tail, which extends from the claim made coverage is terminated. So tail coverage is once your coverage is terminated, they give you a certain amount of time. The tail, they give you a certain amount of time for you to they cover you basically. Theft, well, I don't know, I have to explain this. Third party coverage protects insured but pays third parties, individuals who are not actually part of the insurance contract. So third parties, let's say if you're driving a car and you hit somebody and it's your fault, the third party, that person you hit, they're gonna get paid from you because it was your fault. That's what third party is, because of the negligence. Thank you again for watching this video. I hope I explained to you the best of my knowledge. Everything was correct. I apologize in advance if I made a mistake. Thank you again for watching this video. I hope you guys enjoyed it.